At goldsilver.com, we have a price match guarantee, free shipping, and global storage options. Get the best-selling book, Guide to Investing in Gold and Silver, for free at goldsilver.com.
What is the next chart that you want to show us?
Let's have a look at chart number 11.
Okay.
So that basically shows us, in the
inflation
British
against the global economy. Yeah. Wow.
Well, actually, in the London Metro, they say mind the gap, and this gap between inflation going up and economic expectations going down, this is really important to have a close look at. And I already said that we wrote a special report called "The Boy Who Cried Wolf" in fall 2020, and we warned that inflation will become a big topic. And we used this fable by Aesop, the boy who cried wolf, and now we are also seeing this bear approaching, and this is on the cover of our report, where the bear is kind of coming from the back. It's showing up slowly, and this bear obviously shows, first of all, economic weakness, but also the bear market, and also the Russian bear that is influencing inflation numbers, that is influencing markets and politics. And I think, Mike, for us, it was really important to make a deep dive into this topic of stagflation, which is, we didn't really know that stagflation is a topic that is kind of under-researched, because for Keynesians it was something, Phillips curve and so on. Stagflation simply wasn't possible, and it was actually the uncle of Alistair MacLeod, who you probably know right well.
Sure.
It was Ian MacLeod, and he first used the term stagflation in 1965, when he said, when he described basically the British economy with inflation reaching the 6% mark and the shrinking economy. And so we said, okay, well, let's make a deep dive into the topic of stagflation. And actually, it's interesting that there's only kind of a qualitative definition of stagflation, which is based on 4 different pillars. It's, first of all, high inflation, obviously, then low or negative economic growth, high unemployment, and growth below potential growth. Which is also kind of a Keynesian term. So we said, okay, let's come up with our own proprietary definition, and then based on this definition in this year's report, we'll calculate the performance of various asset classes and various sectors during those stagflationary environments. Now, we call this report Stagflation 2.0 because we both know how the last big stagflation ended. A gentleman called Paul Volcker stepping in and raising interest rates up to 21%, which is, he was afterwards, he was celebrated for that by investors and also by monetary hawks, but he was probably one of the most hated men back then.
Yes, I mean, I was alive then, and he was demonized
back-to-back recessions.
That, right, the double dip recession.
Exactly.
That was, and Reagan was trying to get things started again. We had just come out of this very bad period, and Paul Volcker was being demonized by everybody. But it shows you how independent the Fed was back then, and how they would just ignore political policy and what the politicians wanted and do what they thought was best. So Paul Volcker put a lot of discipline on things. I don't think we've got the same type of leadership going on at the Fed right now. So, anyway.
And we've got one great table where we actually compare the stagflation of the 1970s to the current stagflation, and I think there's some similarities, Obviously, the supply shocks and especially oil prices were a big thing back then, and are also crucial at the moment. Then we saw price controls in the 1970s, and we're also seeing them. We saw very high budget deficits, but actually in the 1970s, I think the maximum budget deficit was roughly 6%. In 2020, we saw 15%. And how did the big stagflation of the 1970s end? Obviously, with those interest rate hikes. Now, the thing is, I think that's a very, very basic concept that still many people don't really grasp. The higher the debt level, the debt mountain, the bigger the sensitivity to rising interest rates. Now, if we compare the current debt situation to the 1970s, well, actually, we've got on a government level, debt levels are 3 times as high. On a corporate level, they're twice as high compared to the 1970s. And if we compare private households, it's also twice as high now compared to the 1970s. So therefore, I think it would be naive to believe that Jay Powell is the new Paul Volcker and will aggressively hike interest rates to really win the fight against stagflation. It's just not possible anymore. So we write in the report, a sustained return to positive real rates is as likely as a remarriage of Amber Heard and Johnny Depp. So I wouldn't really bet on that.
Right. I absolutely agree. I just think that the world's central banks have painted themselves into a corner, and there's just no escape for them except I don't think this will end well. That Ludwig von Mises quote of that a boom brought on by credit expansion ends in a big bust, or if it's basically papered over. I can't remember the exact quote, but or if you don't allow the boom to correct itself, then it will end in a total catastrophe of the currency system involved. I think that's where we're headed, and that's the reason I'm in precious metals. What's the next chart you want to talk about?
Let's have a look at chart 13. I think this is really to understand the big picture.
Okay.
And what we talked about before. That's really crucial. Now, what we see here is the so-called Great Moderation. This is a term that was used by central bankers, basically saying, well, we did a tremendous job over the last 40 years, and inflation is not a topic anymore. The inflation volatility is extremely low, and we actually saw 4 decades of constantly falling inflation rates. Now, from our point of view, and we wrote about the monetary climate change last year, where we said you should prepare for an inflationary decade. Now, from my point of view, this Great Moderation obviously is over, and I think it's important to understand that we've had those 4 decades of falling inflation rates also mean that basically all professional investment advisors, fund managers, but also politicians, central bankers, consumers, we are all basically used to this low inflation environment. Now that inflation really is a topic again, so many people are caught on the wrong foot. Nobody really knows how to navigate in this environment. Right. And therefore, I think that we've got this recency bias in our psychology. I think everybody thinks or hopes that we'll go back to this Great Moderation era again. But what I really sense now over here in Europe, I think this inflationary mindset is really getting started. So I think a wage price spiral will start spinning very soon. I think, you can talk to business owners, you can talk to investors, you can talk to people on the street. Inflation really is a topic again, and I think it will be it will be tough to get this inflationary mindset that we usually only know from emerging markets. It will be tough to get that inflationary mindset out of our heads, and I think this is really the big challenge for many investors, accepting, well, we are now in a new environment. Inflation should be very important for all your investment considerations. While I think we write in the report, over the last couple of decades, talking about inflation or understanding inflation was as important as following the snow forecast in the desert. But now it's really it's probably the first thing, or one of the first things as an investor, that you have to consider for your asset allocations.
Yeah, and one of the things, the next chart, 14, points out exactly what you are talking about. So this is the producer price indexes across the Eurozone, and there's the USA in there. So it just shows you that this is a global event. It's not just one economy. It's all economies across the planet.